Okay, welcome everyone. Let's get right into the stock market technical analysis. Going to go through what I see in the charts today, cover gold, oil, look at the broad markets, and we'll probably wrap up, maybe go through a couple individual trade ideas that I've pointed out, and then we'll wrap up there. Bear with me, guys. I'm running a little bit of a cold, so... and if you guys are new, drop me a thumbs up if you're finding value. All right, let's jump into it because we got some big stuff happening today. So we gapped down pretty big, actually. And again, on Friday, and really, on Friday, I basically reversed short, talked about how I was reversing short. Today, with the gap down, I'm looking at potentially starting to take some profit in some of these shorts. We're right ahead of the Fed. The Fed's coming out on Wednesday. We could crash into the Fed, just continue to sell down into the Fed, and I'll show you the levels, the key levels on the chart to watch for in case we get that. Because there is the potential there. What I've been looking for is ultimately on the triple Qs, you go to the daily chart and the pre-COVID highs, I've got them marked out right here. It's about 238. Now that would be, that should be at least a key level of support. We could crash down to that level. Now that's a huge drop. In the next 2 days. But again, there is that potential. From where we're at now, that would be a drop of about 14% or so. If you were to see that, and again, it's a pretty low probability to get down there that quickly. But if you were to see that, I would expect the Fed to back off its hawkish talk. It's going to hike rates because it's already notified the market of that. But they'll pull off all the future rate hikes most likely. So, or at least take a pause. They'll say we're going to be data dependent and wait and see. They'll do something to kind of ease off. Again, they don't want the market to crash. So my entire scenario, along with this entire bear market that we are now in, again, if the market closes today where it's at, it's going to be an official bear market. But again, if you wait till the bear market's official, you've missed out on a lot of the opportunity. So on this channel, we started shorting triple Qs back on January 4th. And, we've caught most of the moves down, even caught a little bit, we've caught some of these rallies on the way up. We don't get it all. It's impossible to catch every single little inch of the moves. But in general, we've been right on the direction. Now, there's a potential setup, all right? If you were to go down there, what I would likely do, you should see the markets will likely rally off of that pretty impulsively. So I don't think we'll get there. Another key level to look at is there is a level here at about 267. I got it at about 267.20. It's kind of this, there's some reactions right in here as a potential level. So that might be a near-term support. And then also we have this bullish falling wedge, and the bottom of the wedge is right down there at about 271. So we're kind of in the area where we're near support. We're at least near some close supports, and we got the Fed on Wednesday. So it's really hard to gauge what the market's going to do. Just watch the price action. If you're going to continue to crash, then likely it's just the market's sending the Fed a message that, it needs to ease off. The rates can't go up that quickly because of just the dynamic of all the debt. And so that's something I want to point out. TNX, this is your 10-year Treasury. This is very alarming to me because I'm seeing, this is up 6 0.2% today. This is your, this is basically what mortgage rates are built off of, credit cards, car loans, all kinds. Basically, the economic credit is pivots off this interest rate. And you can see we're at a new cycle high, running back. And if I look at the weekly chart, this is really what's kind of a little alarming. But this is going back all the way to 1981, pretty much. So interest rates have been in a bear market for my entire life, and they have. For the most part, if you're a baby boomer, part of that generation, then most likely you weren't investing when the interest rates were dropping. You were in your 20s or so, and interest rates have been dropping in your entire life. So that's where a lot of the fallacy of the market always goes up over the long term comes into play, because financial Financial advisors, pretty much this has been their entire life and definitely their entire career. And so that's dropping interest rates. Well, let's zoom into where we're at today. You can see we've kind of broken to the top side of this channel. Broke out, back tested, and we're continuing to rally. Now this rally is coming with negative divergence, so I think there's a high probability that it fails here and we don't go too much higher. Again, likely going to be pivoted off the Fed. If the interest rates continue to climb here, even though you need interest rates to go higher in order to fight inflation, they can't go higher in the current debt dynamic that we have. So watch this. If you see this drop back below here after the Fed, that's just going to kind of signal to you that the Fed's not really going to fight inflation. All right, they have the opportunity now. If they want to spike these interest rates and continue to push these things higher, they can come out extremely hawkish and push interest rates higher and really put out, really try to fight inflation. But if the interest rates drop back, that's just telling you that, okay, the Fed isn't really going to fight inflation. They're just going to act like they're going to and talk like they're going to, but they won't. So if you see that, you should see gold rally pretty strong. We'll go through gold here in a second. Okay, here's the S&P 500. You can see gapping down today, making a new cycle low. The pre-COVID highs and really my target for this move, at least this leg down in what we're seeing as a bear market, the initial leg down, is right down here at 338.50, 339, somewhere right in there. So that's your pre-COVID highs right here. So I think we're heading down there. Whether we bounce here and maybe fill the gap, I don't know how it's going to play out into the Fed. Usually you don't see big moves take place right before the Fed. The market kind of goes into a holding pattern, but obviously today is a really big move to the downside. So that could continue into the Fed on Wednesday. I would put lower probability that we're going to crash into the Fed. I think we'll probably, the move today is likely going to be, that's probably all we're going to see to the downside leading up to the Fed. Maybe we'll continue lower after the Fed, but I think the move today is probably the message to the Fed. Small caps, IWMs at support 170, 50, 170. So that's kind of your pre-COVID highs in the small caps. We already hit it once before. We rallied off that level and we're back down there. But again, it's still support, hasn't been taken out. So until you see that get taken out, you should hold here. XLV. So this was one of the last holdouts, one of the areas of strength. This and energy basically in the market. So this is coming off of the 2009 lows on the weekly chart for the healthcare sector, XLV. You can see support. We held support all through here. I've got all these tags circled. This is COVID. It's kind of an outlier. It was just a liquidity event. So I kind of just just throw that out when I'm charting this. But all the weekly things, and then boom, there's a breakdown actually on the weekly. So we gapped down today. We were at support. There was this trendline support here and then horizontal support you can see coming right there at about 124.55 and it gapped below it. So that's a breakdown in healthcare. That is a sell signal across the broad market. So this is a defensive play and it's showing that, I talked about this, in a bear market, even the defensive plays are going to get taken, they're going to sell down as well and get sold off. So that's what we're starting to see now. We've already seen tech sell off really strongly. Now we're starting to see the defensive sector sell off, the broad market sell off. I think we're getting close to the end of this first leg down where we'll probably get a sustainable bear market rally that might last, maybe a couple months, not just a few days. But before that, we could potentially crash down to those key levels I pointed out. So maybe we crash down and then rally. I mean, obviously, we're seeing this starting to break. So this is likely heading lower. And maybe there's some more downside in tech. So it's just all really about watching those key levels. The oil sector, continues to break down, but still at support. So here's XLE. It kind of undercut this trend line here. So I've got several tags of that. We just hit it, and that's where the dip buyers stepped in. So No definitive sell signals that I see on the sector, but I think it's probably a matter of time. Maybe we'll rally into the Fed and then break after the Fed. EOG, I shorted this one last week. I covered it today. I think we're still heading lower. Again, we've got this price channel here, so I assume that we'll probably continue to head down towards the bottom of that price channel. But that doesn't, maybe it takes time. We could hit it right there. So I think most of the drop this morning, covers a lot of that. So I need to see this probably break, this trend line break for the next sell signal. And then DVN, this is one I've been really watching, wanting to short. It's right at trend line support. So this is your bear market or your bearish rising wedge. We basically were at the top of the wedge here and just made a swift move over the last 2 days right to the bottom. Even undercut it, but the dip buyer stepped in and they're holding support. So no sell signal, just very close. We'll watch in the next couple days to see if we get a breakdown in some of these things. And that will signal likely a pretty good sized move to the downside in oil. Okay, gold. So gold had, across the board in my miners on Friday, I talked about how gold had bullish engulfing candles, and all the miners had bullish engulfings, the ETFs all had it, but we needed to see confirmation. And again, if you don't know what that is, check out my stock market technical analysis course. I talk about those concepts in the course, and I teach all my ideas and trading strategy in that course. I priced it affordable for all, so if you're interested, check out the link. And looking at, like, here's GDX, big bullish engulfing here, but no confirmation, no follow through. So not a reversal candle, at least not yet, unless they rip this thing into the close. Just not seeing anything there. So, if we don't take out the lows, we might be able to still consider this a bullish engulfing, as long as we don't drift beyond the lows here and really get a close down there. We might just trade around here and then get follow through. Probably going to go into a holding pattern into the Fed. I think the downside move that we've seen is probably done, and we'll probably just chop around here into the Fed. So we'll see. I still like gold, still looks bullish to me. If I look at, the most recent move, well, if you go to the hourly chart here, you'll see that basically we're still, trending upward here, still kind of making an upward trend. We kind of just popped off support, hit resistance, which is right there at about 1875, maybe a slightly lower, maybe right in there, but and then headed right back down to the trend line support. And we're just holding there, so still bullish. Got to give it a little room. Obviously, things get volatile sometimes going into the Fed. And this Fed meeting, each Fed meeting is going to be really big because we're in the middle of an interest rate shift, kind of a big change in the markets in terms of like 40-year long trend lines. And I showed you that TLT and the TNX, the interest rates, and we're starting to see changes from the last 40 years. So lots of volatility, obviously. Looking at stocks like Barrick Gold, you can see here's your bullish engulfing candle. And today, obviously gapping down, still hanging in there though. We've only kind of given back about half of those gains from Friday. And the buyers have been stepping in. So we'll see how we close. Obviously, if you rally into the close and you close up above that candle, that would be extremely bullish. And we'd probably say that's confirmation on this bearish engulfing candle. I don't think we're going to get that, but you never know. Likely we'll just hang out here into the Fed. Okay, PANW, one of my favorite short trades. We're bouncing off support though. So you can see here, the pattern that I'm really trading is this big bear flag. All right, you got a bear flag. We broke to the downside, but we did hit support right there at 475. All right, that's pretty decent support. You can see it's support here, support through here. And it was support right there. So we hit that level and we're bouncing. I think this bounce should be short-lived, but again, with the Fed on Wednesday, it just really leaves things to question as to where we're going. So we could rally, at this point, maybe rally up, fill the gap, hit the trend line. I need to mark this out a little bit cleaner, but it's maybe something like this. it's not even a defined trend line yet. So actually, I really need to just get rid of it. Maybe we run up and fill the gap. We could even run up and fill this gap way up here. Anything can happen into the Fed. It really, with such a big event just in the next couple of days, I don't think it makes a lot of sense to be really heavy any one direction, whether you're long or short, especially after today's move. If you were short coming in today, to me, it makes sense to take some of that profit off the table, lighten up on positions, and then wait for the Fed to clear out of the way before we get repositioned. That's what I'm going to be doing, and I think that's prudent. I think that makes sense. Zen, if you're still in this one, this thing's basically just crashed. So again, great short, if anybody's still in it. We called the short right here. We had the sell signal back on May 24th. If you took that sell signal, maybe some point in the midday, this thing is already down 37% at the lows in a matter of just a couple weeks. So it's pretty much crashed. Again, I liked it as a short because, for one, it's a tech stock. Two, it hadn't broken down yet, where all the other tech stocks, many of them had already broken down. So it was kind of a holdout, but it looked like it was going to be weak. We had an uptrend line to watch. We had negative divergence on both momentum indicators, and we got the sell signal. So that's all the, again, like in my course, I put together a checklist which really goes through each one of these steps that I just showed you. It really says, okay, check for this, look for this, look for this. If you have everything, then you've got a high probability trade. Doesn't mean it's going to work out, and that's where money management and risk management comes into play, but it gives you the best probability, or at least a good probability for the trade to work out. And that's the best we can hope for. Okay, commodities, DBA. This is a basket of ag commodities. You can see here, there's your uptrend line. We've got the upward trend. Today, gapping below the support line, but the buyers are stepping in. So we'll see where we close. This isn't good enough for like a sell signal or a breakdown, just not clean enough. We do have negative divergence, all right, on the momentum indicators. So I think we're going to get a sell signal in these ag commodities, but we just don't have it yet. I think maybe they'll hold it here, rally it, and then after the Fed, maybe we get that sell signal. The inflation is not going to peak and come down until you see these things break. All right, when these things start to break, then the inflation readings will come down. Well, they'll start to come down, and the market will likely start to rally off of that once they get a good inflation reading or a reduction in the rate of inflation. The markets will likely rally, thinking, okay, that's the end of inflation. Let's rally. And that's how that's set up. I don't believe, and these ag commodities will continue to correct. I don't believe these ag commodities are likely going to be a buy the dip situation because they have started a new bull market. But again, that doesn't mean they're not going to have corrections. And I think this one's due for a correction. So likely what's going to play out is these are going to start to break down. You'll see the markets rally in a bear market rally. A relief rally based on the fact that inflation's starting to come down. But then you'll notice that inflation doesn't actually really go down too far, and it really will be sticky and hold up. And then we'll probably see the market sell off in the future. And I'm talking months down the road. But that's how I think it's going to play out. Okay, that's all I have for today. If anything gets crazy towards the end of the day, I'll put out an end of the day market video. Otherwise, I'll catch you guys on the next one. Bye.